Greetings to all and welcome to this very interesting webinar that is being hosted by IBS Intelligence in partnership with Loxon. Uh, we have with us a very interesting topic for discussion today. We all know there's been a significant impact that all of us have been facing in our own walks of life uh, around the world due to the pandemic. But we picked a very specific streak for us to have a conversation around what the impact of this pandemic has been, specifically on the credit moratoria, and on NPL management. We have a very interesting panel that would be covering these topics today. Firstly, I do have with me the chairman of Loxon, Tamas. Tamas Erni comes with a lot of experience, and he actually is highly regarded for his, for what has been a very interesting technology approach to solving a lot of issues around the world. They have clients about 70 plus tier one and two banks, and I'm told that the products of Loxon are being used by banks in more than 25 plus countries, and that's remarkable considering that it's actually a focus area which is very niche and very specific and extremely interesting as an offering. I've had a chance to see some of his solutions, and it's quite interesting. Uh, Me, the moderator, I'm a senior partner with Cedar Consulting, the parent firm of IBS Intelligence. And IBS Intelligence, as you all know, is regarded to be a global leader in the space of fintech research, publications, and advisory with our clients around the world, 100 plus countries here. So we also have two more panelists would be joining us. I would quickly give the background of these two gentlemen who would be joining on the panel shortly. We have Mahdi. Mahdi is the head of business banking at Abu Dhabi Islamic Bank. He comes with about 28 years of experience with specific focus around all aspects of banking, be it retail, SME, project finance, as well as in micro finance. Prior to Abu Dhabi Islamic Bank, he used to work with CBI, and prior to that with Islamic International Arab Bank. We would also be joined shortly by the global head of retail credit, Mr. Praveen Khurana. Praveen Khurana is the global head of retail credit at ING Bank. He's based out of Amsterdam. He comes with a very large global experience across multiple markets between Netherlands and India and Philippines and China and a lot of countries. And he comes with a lot of experience again behind him, with experience. He started his career with Citi, and then he worked with various banks. And presently he's heading the global retail credit at ING Bank in Amsterdam. So without waiting further, if I may invite Tamas to share with us some perspectives from Loxon, particularly on NPL management. But while we have Tamas come online, I have to make sure that you in the audience have a small homework to do. So we would be actually having a bit of a poll that actually gets to gauge your own perspectives on a number of topics. And I want to start with a small poll. So if you could, from the audience, if you could share with us your view on which customer segment suffered the biggest impact due to the COVID-19 pandemic. Has it been large corporates? Has it been SME? Has it been mid-size or commercials, or has it been retail? So, Tamas, let's wait for some interesting results from the poll. And I guess we'll have some perspectives to draw from here, as we get into the webinar, which is quite promising as a topic for us to take away from here. So while the audience is polling, Tamas, if I was to ask you to pick, what would your pick have been?
Well, my pick would be SME.
Interesting. And why would you say that?
Because SMEs will be basically hit from all angles. They are hit because they are supplying products to many of the corporates. where the demand is shrinking. Their demand is directly shrinking wherever they are directly selling something to the people, plus even their employees are hit because of the COVID and the changing environment. So they are hit from all possible angles.
Interesting. Interesting. So let's see what our audience have polled, and let's see if you are with the audience or not, Tamas. We'll know in a second. And bingo. 78, an overwhelming 78% people are have the same view as you, Thomas. SME clearly seems to be the most impacted segment in the views of what our audience also have to say. Quite interesting, and thank you, members of the audience. So, if I may request you, Thomas, to actually you have a presentation I know to share. So maybe if I can request you to share with us your perspectives on, particularly on NPL management and from a Loxon standpoint.
Yes, thank you very much, Ram, for the introduction. It was a very interesting poll showing how we see the major impact, actually, that the COVID-19 is exercising all over our world. And one of the areas that is mostly impacted is most probably lending and primarily the existing portfolios and problem loans. So first of all, I would like to welcome everybody. Sorry, let me see and share my screen. So, welcome everybody. Good morning, good afternoon, good evening if you are joining us from somewhere in Asia or even in Australia. Thank you for being with us today. It's a pleasure for me being here and sharing with you some of our views about the present and the future of problem loans management. But actually, before we would jump to the details, let me quickly introduce you Loxon. Who are we? And why am I talking today? Our company was established 20 years ago, back in 2000. And in the last 20 years, we grew from a small fintech startup with only 3 employees providing Java developments for a single customer in Hungary to an internationally recognized vendor, one of the worldwide leaders in our core markets, lending, collection, and risk management. With 7 offices so far, working, as Ram already mentioned, in more than 25 countries on 4 continents, from Madrid to Sydney, from Moscow to Lagos, with or close to 100 customers and partners. In these 20 years, end-to-end non-performing loan management, starting with early warning, pre-collection, soft, hard, and legal collection, has become the flagship product group of Loxons, with reference customers in Europe, the Middle East, Asia, and even Australia, like ING Group, that is one of the top 25 banking groups on the earth, or Home Credit International, one of the top 5 largest consumer finance providers on earth, Sberbank CEE, or Abu Dhabi Islamic Bank. But when I look back for the last 20 years, actually collection, how we see and manage it today, is completely different than collection when this journey started 20 years ago. We as Loxon, we developed our first collection platform back in 2003. This was the time where the major focus of collection was actually automation of human tasks. Then it changed. The first major change came with the 2008 financial crisis. And together with the banking industry, solutions for supporting non-performing loan management and collection started to change rapidly. we innovated from this platform back in 2003 through multiple stages to reach the present state in 2020, where collection system evolved from a tool to manage non-performing customers to a completely different function that is an integrated part of the customer journey, strongly customer-centric. To mostly outbound collection focus back in 2003 changed to a customer-driven focus, a heavy motivation provided to customers to use inbound collection techniques like chat or even a self-service collection module. Static collection scoring models are replaced by very dynamic machine learning driven methods with a focus on prediction and simulation by collecting large volumes of data, primarily about behavioral factors. Because in today's dynamically changing environment, we more and more have to rely on understanding behavioral dynamics of our customers and approach collection by understanding these behavioral dynamics. We are collecting data not only from the bank source systems, transactions, account information, but all the behavioral elements under collection and from any external sources that are available for the bank. The collection platform of today and the future is definitely supporting very quick changes, rapid experimentation, simulation, champion challenger valuations, so that at any point in time, we can see what will be the next steps of our customers. We can communicate with our customers over their preferred channel, not one of the old traditional ways, and we understand their next steps, and this way we cooperate with our customers. And this is what you can see. So basically, as in 2003, collection was seen as a very pushy activity, the bank trying to get in touch assertively with the customer and trying to get as much money back as possible. While now, in 2020, and we truly believe it will especially be valid now after the credit moratoria provided by the governments and the central banks all over the earth will expire, that nowadays collection is about cooperation. That collection can only be successful if it provides the success to the customer. So collection becomes an integrated part of the customer journey, and the banks can use it to actually strengthen customer loyalty. The emphasis moves towards a customer-driven collection and not anymore on the outbound communication channels. Of course, in the digital era, after the fourth industrial revolution, as all parts of banking, collection as well becomes fully digital. And when collection becomes fully digital, one of the points that we will see is that certain activities that we are doing now on premise might even go to the cloud, even in countries where today the usage of the cloud for customer data is not possible or not feasible. And this is what we see in the last 9 months, one of the major changes that is driven by COVID-19. COVID-19 did not only completely change customer behaviors, customer personas that we use in collection, but COVID-19 also completely changed how banks see cloud, public cloud, remote access to the systems. Certain things that were basically impossible from a bank security perspective became a reality now in December 2020, and we expect this will grow. The reason I'm telling you is that there is one major difference between deploying the future collection system on cloud or on-premise, and this is speed and complexity. The new generation Loxon collection system can be deployed on the cloud. Now, by one of our customers, it took us 4 weeks to deploy an MVP product and the customer to start using them. I emphasize as an MVP product. So this provides you speed and reaction time. With an on-premise implementation as well, we are significantly faster than even 3-4 years ago, but the complexity of the environment is still a little bit higher. And why it is important? I collected for you not too many statistics, basically 2 statistics. One of them is a forecast of the European Central Bank, where they are forecasting the percentage change of non-performing ratios in the major European economies. And as you can see, compared to the end of 2019, the minimum change in the non-performing loan ratio will be more than doubling. And you can see that in the most heavily hit economies, it will actually be even more than 4 times, 4.5. In the case of Turkey, the prediction of the European Central Bank shows a 5-time increase in the non-performing loans. So with such a rapid growth of the problem loan portfolios, time is of essence. The faster you react, incomparably better results you can gain. When we see the forecast that comes from IMF or Standard & Poor's, you can see that for the GCC markets, for example, the 2020 estimate is already increasing, and we expect the same, although not as a rapid increase as, for example, in the European markets. But still the expectation is steady. We need to deal with a significant increase in non-performing loans. So let me summarize what are the key points managing them. Well, when we see the characteristics of the future portfolios, these define the major characteristics of the future collection solution. A very strong primary customer centricity, providing all the channels to the customers to understand what is their exact situation, provide them advice and the tools so that they can manage through self-service, through any digital communication channel they prefer, their own collections. Optimization in every layer of managing the customer relations, and optimize the user experience by providing the preferred communication through the preferred channel of the customers, by an understanding of the personas of the various customers and understanding the personas, for example, of our own collection agents, and trying to match the psychological persona of the agent who is getting in touch with the customer so that we find the best possible fit. And not only in customer communication, but a very fast reaction time on the changes in the environment. The solution should be able to predict the next moves in the portfolio and prepare for these next moves. Analyze what are the proper entry points of starting the collection and what are the proper exit points where, for example, further collection is more costly than what it provides as a benefit, even with keeping the customer, and in this ways predict what is the proper time when we can start to give the portfolio to an external collector or to even sell the portfolio. Efficiency is the next. Of course, the solution should focus on efficiency all over the portfolio because we all expect that the income base of banks will shrink, Therefore, one of the measures we will see in all of the banking customers will be trying to find ways to automate as much as possible to optimize the use of human resources to the highest level possible, and through this way as well reduce the cost of collections. And also, we should not forget that in the next half year, 1 year, there will be a large volume of customers who still will become non-performing after the moratorium provided by the local government or central bank has expired. And we need to find ways how to manage these special cases of customers. So let's spend some more time on artificial intelligence and machine learning. Well, collection sees the renaissance of machine learning models for various reasons. The most important is most probably that it is much less regulated by the central banks at a process level. Therefore, banks, as long as they remain within the boundaries for consumer protection and non-performing loan management provisioning rules that are provided by the central bank, are free to choose what are the methods, what are the tools, what are the processes they use to manage the customers. So this gives ways to continuous rapid innovation and optimization. I brought you 4 examples where we are using already today machine learning in the collection process. One of them, and maybe the most important one, is customer behavior analysis. Try to differentiate the various types of personas. Just to give you a few examples, try to understand who are the self-healing customers who actually don't even need to be approached, because even though they are problematic, even though they are in the delinquency, but we know that they will repay even if the bank does not approach them. We have a major customer, I cannot name the country, in which country, where we made such experiment and we found that the model with an 85% precision found the self-healing customers who did not need to be called or any action made. They were paying back the money. Also, another aspect is to clearly segment the non-cooperative customers, because with the cooperative ones, there is a completely different way, different cost to communicate, whilst with the non-cooperative ones, we need special tools, how to manage the relation, and we have to decide whether we can change their behavior, and if not, whether we still want to manage the relation. Of course, we need to apply the proper communication tools. Let it be calls, let it be letters, because they are still mandatory according to the central banks, or self-service collection, or even social media. And another aspect that I would like to emphasize is that machine learning does not and cannot stay on its own. Machine learning best works if we combine the power of the machine by focusing machine learning on issues that are complex for human experts, but we still combine the power of the machine with the power of the human experts by clearly defining the problems and finding from the machine learning options the best fit to our portfolio. And as a summary, all about I was talking to you is of course only one side of the coin, because there is no software, there is no process, there is no solution that can provide proper values to our customer and your customer unless we truly join together as two partners to provide the best possible solution for you and your customers throughout the end-to-end non-performing loan management journey, empowering the customers to take the right decisions, to find the best way to cooperate with us and to repay whatever they owe to the bank. And if this journey does not go through a continuous innovation that helps us at any point in time to find new and better ways to manage the non-performing loans in today's very highly changing environment. And this means also that the way how banks and vendors work together had to change. Today in 2020, we don't anymore talk about large scale 9 months, 12 months, 15 months, huge implementation projects of a non-performing loan management system. But we talk about quick implementations, rapid deployment within a matter of weeks and not months, starting with a minimum viable product providing immediate business benefits that you can use, and based on the usage of this minimum viable product to identify which are the next and the next most important business challenges that we can best solve with the new solution, and this way optimize the added value to you as our customer that you can provide to your customers. So this is what I wanted to tell you today. Thank you very much.
Thank you, Thomas. That was indeed quite interesting, and I guess the days of long drawn implementations are gone, and the investment in a technology implementation, if it is not in an MVP, is in itself an NPL, right? So you have to make this really impactful, and time is of essence. I completely agree. Ladies and gentlemen, we are now joined by both our eminent panelists, Mr. Mahdi Kilani. As I mentioned before, he is the head of business banking at Abu Dhabi Islamic Bank, and Mr. Praveen Khurana, who is the global head of retail credit risk at ING. Welcome, Praveen. I know you're joining from Amsterdam, and Mahdi is in Abu Dhabi. Welcome to this panel. We just had a very interesting session from Tamas, and since we have both of you on the panel, I'll probably take the liberty of interchanging the questions between both of you as we move along in the next 30 minutes of our discussion. And probably I'll start, with you, Praveen, and then I'll quickly move to So, I mean, if I was to ask you, I mean, since there was a discussion that Tamas talked about NPL, extensively, what implications of does the moratoria, specifically driven by COVID, do you think has an impact from an NPL management standpoint, Praveen?
Yeah, thanks, Ram, for inviting me over. I hope I'm audible.
Yes, you are.
Okay, great. Thank you. So I think in my view, Ram, NPL is an end state. So we'll have to really look at how the thing transform through the journey before it hits the NPL. And actually, COVID is making it even much more tougher because if you come to think about it, all the balance sheets are looking quite healthy right now because customers are running a payment moratorium or payment pause, as few countries may call it. So it's not really reflecting the correct picture. So I think the challenge is NPL at the end state for sure, but how do we cross the journey and be sure that we don't get hit by the surprise at end of quarter 2, end of quarter 3, depending upon what is the kind of a moratorium which countries have really established for their customer base, right? So in my view, I think more than NPL, it is a staging which matters a lot. And also, I know Tamas is working with his team very hard on providing early warnings, right? So I think that is something which is a key to the success in my view. And if I break this answer into two parts, Ram, where I break the retail portfolio into two, at least in my segment which I manage, as private individuals and SME and mid corps, right? Now, things for SME and mid corps is slightly easy because you have the cash flows coming in. We have industry level views. We have underlying industry categorization. So you can still make some educated guesses, okay, or let me say forecast, where you can try to take some overlays, or you can try to put certain provision levels so that we don't get taken by the surprise. I think when we come to the private individuals, it becomes even more tougher because you have very limited information flow. You don't have cash flows coming in. So that is where you have to think out of the box completely. That what is it that you can do to establish that out of your portfolio that you've extended on the payment holiday, how much of it could get into the trouble once the payment holidays expire, and probably start looking at it from a provisioning point of view, or from maybe putting into stage 2 or a stage 3 in advance, calling them defaults in case you can identify the unlikely to pays. So a combination of that would, according to me, be the real challenge there, and not the NPLs finally.
Interesting, very interesting. But I think you touched a very interesting segment out there, Praveen, and I'll probably shift to Mahdi, who actually looks after the business banking portfolio at Abu Dhabi Islamic Bank. Mahdi, you could hear us, Mahdi? I see you're on mute, so I wasn't sure.
Yes. I always do it on mute.
I mean, if I can, again, thank you again for joining us in this very interesting panel. And I know you're looking into this day in, day out from a business banking standpoint. And if I can ask you, two parts of the question: how do you think this whole thing has manifested itself for corporates vis-a-vis the SMEs? And specifically, again, from a moratorium standpoint, how do you see this unfolding for the SME and business banking segment?
Well, I mean, I think everybody has witnessed a huge slowdown. And I believe countries are going into contraction really. But I mean, there are certain segments, and sectors has been badly affected. Others has really benefited, internet banking and the word is not helping me. It's the hammer is hitting us these days because of a long time at home, working from home. Anyway, what I'm trying to say is that there are so many businesses that really benefited, during the COVID, like the e-commerce business. E-commerce has seen a lot of surge, especially deliveries, and small traders are doing really well because everybody was held at home. While the mainstream businesses have really been hit badly. And large corporates, we have seen, I mean, I could talk about UAE because I am very close to it, but it's a reflection of the world economy, definitely. And large corporates has suffered a lot, and we have seen NPLs going higher and higher. And I've seen what Tamas has shown that the UAE has gone up from 4.5% to 6%. And I believe it's going to show more than that. This is reflected by the net profits of the banks. The banks in the UAE, the least bank has showed 20 to 25% less in net profits this year. And when this year unfolds, I would believe we'll see on average between 30 to 50% of profits coming down, in banks. And this is a reflection of the economy. And the large corporates really have suffered. There is no businesses, and there is the inflow. The governments are busy actually trying to manage the COVID issue in the health side, and so the public expenditure and for the mega projects has stopped. I talk UAE, for instance, oil and gas is the main driver in this country. Of course, in Dubai we have the other businesses, which is the cross trading and tourism. This is all stopped, But luckily, if you look at the and this is an outlook for the future. The UAE has gone back into business in the last 2-3 months, and I believe life in Dubai is really almost normal. And we started to see the tourism coming back from China and from Russia. We are seeing back again some trades happening, and the aviation is working again. So it's two sides of an equation, right? You see that there are the large corporates are still suffering, but there are certain segments that have really benefited from this thing. It's really contradicting, you cannot say that the pandemic has really killed the entire industry. There are industries that have seen rise in business, and there are others that have seen really slowing down.
Actually,
So
that brings me to a very connected question there. How do you deal with stress testing in this context, right? I mean, now that you're actually having different industries having different experiences or responses to the same stimuli, what's a different approach to stress test that you would adopt, and what's your view on how that is likely to stay, or is it likely to change? What's your view on that?
actually, the stress testing that we have adopted has been severe, actually, because usually you do stress testing at a 10% up, at 10% down, and you do all these things, But we have seen the worst case. We have made 3 scenarios for stress testing this year, and where we have, let's say, the least, the less, and the worst, So, and the way I see it, the issue that these circumstances, COVID circumstances, really makes risk management so they're on their toes, and they are not willing really to cooperate and to open up, while and post-COVID, hopefully in the next 6 to 8 months, you need to come back. Businesses has to come back. Cash flow has to be injected into the business, into the industry. Risk management with their mentality at the moment, with high, levels of aggressiveness on being too shy to give credit, it's really something alarming, As I said to you, we have 3 levels of stress test. We started with level A and B and C, but in the early COVID areas, we passed the level 3 within, let's say, 30 days. But of course, now, as I said to you, in the Emirates, it's coming back. Things are coming back rapidly, quickly. So we are now going back to the level 2 of the stress test that we have applied. But dealing and knowing risk management, I think they will keep for the next 2 to 3 years. They will keep high levels of stress testing.
Well, we have someone who's heading the risk function. So let me go back to Praveen. I mean, there's a very interesting business perspective there. So, I mean, what process or credit organization implications do you see this whole COVID-19 having created for banks, and how do you see the future unfolding?
I think let me start with a positive. I think the biggest positive which has come out of the pandemic is people are thinking completely out of the box now, because nobody expected, and this is the worst ever scenario we are in right now, and it's while I completely appreciate the views which you just shared. To me, stress test is equally challenging right now, because for stress test we need some kind of a backup data, we need the trends, and we can build scenarios, but the problem is that across the globe right now, the measures which are being supported by the government are continuing to getting announced as we speak right now. So till the time those measures would be there, we will really not know the real story on the underlying customers. But I completely agree on one point which was just made, that I think it's very important to identify the winners in this pandemic, and that is something where I think every bank is working on, because I'm in touch with so many banks right now across countries, across the globe, and I think that's something which is being done in a very systematic manner by across the financial institutions. We all know that we cannot view every SME, every mid-corp, every self-employed with the same lens, for sure. So I can't share too many details with you because of confidentiality, but absolutely, there is a robust process which is in place to support the business, to identify the winners, so that we do not really pull the plug from these customers, because that's a lifeline, right? So we have to continue to support them when they need us, but also we have a way to support the customers who are also into trouble or who are also into the distress, right? Because you cannot be really walking away from them. So that's a two-prong approach. To answer your question, Ram, what it changes, I think it changes the complete need, the way the credit is being assessed today. Okay, so gone are the days then we will look at the past trends or the past historical performance. I think the models have to be absolutely robust now. It has to be transactional models, it has to be behavioral models, which could be real time, and on a month-on-month basis we should know how the health of the customer is, okay, the financial health of the customer is. So I think it really encourages the need of having very robust models. That's one. And to me, I think the automation and digitization would would be the key, because and to get it right, because automation can actually play a role which could be very, very negative, because if you don't get it right, it could be a problem for any institution. So I think these two things, according to me, are here to stay. And since we are the digital bank, everybody knows it. So we really thrive on our automation and digitization modus operandi, and we've been doing it for a very long time. But I think it further makes us believe that it's the right strategy to be in. So that, according to me, would be the future.
Very interesting. In fact, there is a question from someone in the audience, Midja, and this question is posed to actually Tamas, to yourself. I think goes back to, relates to what Praveen just talked about. And the question is this: to what extent do you see AI or ML based solutions supporting smaller banks that probably don't have large data sets required for properly balanced learnings? Your take on this, Tamas? You're on mute, by the way.
Okay. So there are multiple aspects for this question. First, you don't necessarily need to be a large bank with hundreds, thousands, and millions of customers. Already with a few thousands, 10,000s of customers, we can collect enough data, especially when we talk about behavioral analysis, to be able to apply machine learning models. The other is that, especially when banks are using, small banks, finance companies, are using a cloud-based solution, there are ways of, I wouldn't necessarily call it data pooling, because data pooling is not allowed in a few countries, but there are ways to leverage data, non-identifiable data for statistical purposes, that one can collect from multiple customers and enrich the information for all of these customers. So the point is, you don't necessarily need to be a large tier 1 bank to use machine learning or other types of AI.
Got it. Interesting. Thanks, Tamas. Maybe it's time for a quick audience poll as we actually pose a few other questions to our panel here. And I actually am posing a question. The area with the most critical application within the credit function due to the pandemic, in your experience, as in anyone in the audience, to say, would you call it as portfolio risk assessment and stress test? Would it be credit underwriting? Was it collections? Or is it restructuring of loans? So while we have the audience, sharing their views on this, there's a question from William Faraj, and the question is, in the whole impact that we have seen from COVID, how does the whole context of human and team management fall in place? I mean, there is a whole angle to the human element here. Would any of the panelists like to take that question?
Again, what again, explore it, and I didn't really hear you very well. Ram, again.
Yes, Mahdi.
No, I'm saying I didn't hear the question well, please.
So the question is, how do you see the human angle in the, I mean, it's a long question, but I'm just making it as a procedure.
Yeah.
How would you see the impact of COVID in from a team management and internal dynamics from an organizational standpoint, especially from a credit collection team function? Yeah.
Well, actually, I mean, if one thing we have seen and observed is really collaboration, has been really at highest level, because everybody has felt the threat, It's not only on a personal level, also for the entire organization, and everybody really wanted to do more and really to help the people in distress, especially our customers, and one thing that in this country happened, that the central bank has came up with the initiative, and gave a 50 billion for restructuring and for really postponing installments. And this has really made us very close to our customers at all levels. I mean, we used to be sitting at home and dealing and contacting our customers, and they are contacting us and what to do. And we said, okay, just send me this. and immediately we'll send it to our risk guys. Please get us the quick approval. Also, although approval from risk is not really necessary because central bank was really pushing, anybody who wants to postpone, just do it, And we had 2 cycles of postponement from, let's say, from March, April, May until June, and then we had another one until this year, end of this year. And now the rumor has it, and I think it's coming, that there is another cycle of postponement for another 6 months. And this really has helped a lot, but the interaction between the customer and the business guys and the back office and risk has been really great, and this has helped, and then, and customers felt that they are not really left, in the dark and battling their own battle, because, and the issue that we have done in the beginning is really, the focus was on the working capital area, it's just give them money to pay salary, give them money to pay rent if they have to pay rent, It's not ready to do the business itself, not to purchase or buy or sell, it's just to keep the lifeline of the business running. So it was quite, as you said, that it's a threat on all, and everybody was working together in order to hopefully to get over this thing very quickly.
Interesting. So I guess we are discovering new ways of doing things, in the COVID context. Let's see what the poll results are. It's quite interesting. There seems to be a tie here. The audience believe that stress testing and collection both seem to be having equal number of views on what we believe is critical, right? That's fascinating. And actually that brings me, to a related question to you again, Praveen. And I think this is something which is important in the context of what we are seeing here. How do you see the difference in approach to collections? And is this here to stay?
Very, very relevant question. I must say that, Ram, because I think all the banks right now are grappling with one question which regulator is asking, and that is that are we ready for the cliff impact, if at all? Now, it also talks about the operational readiness that, are we looking at the future? Are we really prepared for managing the cliff effect, if at all it happens? To me, it is here to stay now, frankly, because it is going to be the new way of living now, right? So, and there could be a temporary blip which will happen once the payment holidays expire. You will start seeing a lot of customers coming in to the DPDs 1+, where they have to be called, contacted. But I think that is where the tool, if we can have a tool which could probably do a predictability assessment and do kind of a fine tuning of putting the customers in such a manner that we know who to call first, how to prioritize. And again, that leads me to the question on automation, because one thing which is easy is to hire and create a big team of collections, but I don't think so that's sustainable by anybody, right? And that was also your first point, that that's a human element part to it. You cannot have a team there and then no team once you don't need them. So I think to make it sustainable, it has to be kind of balance between the technology, which is actually, again, I'm reaching out to the models because I'm a big fan of the modeling part, because it really helps a lot. And obviously be prepared and plan it in such a manner that we manage our operations much more effectively and impactfully.
Actually,
For sure.
what you're saying, actually, there is a question out here, and it's an anonymous attendee who doesn't want to name himself or herself, but the question is very interesting. So the question is, what are the minimum set of parameters that need to be considered in an AI-based collection application to accurately predict default rates? That's a tough one. Let's see.
I wish anybody in the panel or anybody in the audience would know the answer accurately.
No,
Because
this is for Tamas. Tamas is expert in this.
Tamas, yeah, you should take a question. Yeah.
Thank you.
This is your area, my friend.
Well, honestly, I don't think I can respond to this one, because I don't think there is such a minimum. And primarily because it depends on the economic conditions. It depends on the portfolio of that particular bank. And and of course the behavioral of the customers in that particular portfolio. So usually how we start is to understand these impacts and then see what data we find to build the models. And this will define what are the elements that we need to take into consideration and what data we need to have. And this comes back to the question that Mahdi responded, is that, and I completely agree with that question, is it is not enough to have strategies. It is not enough to have a system, because in the end, these are tools. And usually everybody has tools, just are very automated, some are less automated. Even Excel is a tool, and we can do brilliant things in Excel. What really matters is what is the challenge we have to approach and we have to tackle, and the teams working on it, bank and vendor, the customer portfolio, these will define together what is the solution. Organization, including the people, processes, models, system, and the environment. This is the solution. And we have to see this, and then we have an answer. If we look at the tools, usually most of the people see their tools and they relax. Oh, I have the solution. But the tool will not give us the solution.
The tool is only an enabler of a solution in your view. It's not.
Yeah. We need, Ram, we need and you need the data. You need the data. You have to get the data, and you have to do pilots. This question cannot be answered now definitely, because it needs time, for testing to see what works really post-COVID. What's going to happen post-COVID? How things are going to go back? Are we going to back to pre-COVID areas? Or definitely we are not. Things are going to. The whole life is different. All of us are changing.
Mahdi, I mean, I have to ask you this question, and this is, maybe a perspective that maybe you should share with us. What do you see as the outlook for 2021? I mean, for the perspective of the customer, the bank, and the regulator.
Well, I said, for 2021, it's still early, to say that we will go back to pre-COVID. That's for sure. Okay, it's good news that we have vaccination now and at the doors, but until vaccination happen, it will take at least 6 to 12 months, for immunity to be accomplished. So this is really. So we are going to stay as we are, the way we have been living in the second era. I classify our life March to July and July till date, and this second thing. Before, there was this complete lockdown. Everybody was locked at home, and then everybody's afraid, and nobody wants to go out. No, these things, I think we have passed it, with the precaution that everybody is taking. But life will still be the same. We are trying to cope with the situation and try, and then so on. Everybody is really sort of careful, cautious, on doing business, on going. So 2021 is not going to be a really positive year, but it's a survival year. It's still a survival year. And now the role of banks, and regulators, and as I said to you, central bank in the UAE is really giving us another stage of performance. Banks has to step in, and try and start supporting those guys with a lifeline. If we are going to, we cannot joke, and say that we are doing well, because at the moment, any customer who wants to come with a new line or wants to do a drawdown, there are so many questions and answers. What have you been doing? And as if it is normal days. No, guys. And we have to really to support the businesses now. This is the time. And I think government intervention has to come not only for postponements, also for some kind of guarantees. You have to push the banks to support. I think the second half of 2021 different. People will be starting to go out, will start to build the business again. And I don't see that the outlook for 2021 any different from what we have at the moment. But definitely 2022, things should start look.
We should all start praying more, I guess. Yeah.
Well,
we have just a minute to go before we conclude, and there is one question which I'll probably direct to you, Praveen. This is to do with credit risk management. So I guess you are best positioned. What changes are required in the governance framework of a bank and the bank's credit team structure to strengthen the credit risk management capability? Your take.
Yeah, so I think I don't know who asked this question, but a very, very relevant question, because I think the governance what we used to be having before has to be much more robust. The reviews and the model validations and the model periodic views which used to happen at a certain frequency has to be much more sharper now. And I think many of the banks were also relying upon a lot of data points of the past, which means last 3 years history, last 2 years history. I think that has to be now shortened, because I think it has to be kind of a real-time transactional base for the last 3 to 6 months time, which will reflect the much more correct picture. So all in all, I think a fungibility and flexibility within the teams, collections and credit have to work much more closely, and you have to reinvent yourself much more quicker than waiting for the annual renewals of the policy, or once in 2 years kind of a renewal, because it has to be a kind of plugged in much more quicker. So it has to be much more real time than what it is right now. So I think, and that is here to stay.
And that's
I would like to add something here, actually, Ram. It's actually the partnership between the three lines, let's say the business and the credit risk, and of course collection. There should be a real partnership, because the thing is you just cannot leave the business on their own to fight with customers, and the credit are on the backside just dictating what to do and what not to do, what to accept and what not to accept. System or the spirit of the process really mixed in, there is sort of this disconnect between front line and the second line. This has to go away in order for us to pass this critical understanding of what's happening. And you need to have the mindset had to be changed especially with the credit team. They have to change their mindset. It's not only by the book, it's not only the policy, it's not only what it says. You need to go down and see what's happening. We need to take some risk.
Mahdi is all passion there. I can see that there.
Look, this can be a very different debate altogether, Mahdi. I think I know.
Okay. Before we conclude, let's leave the last word to the audience. And this time I'm going to allow the panelists to also vote. We have a poll here, and let's conclude with the results of this poll, this session here. I'm launching the poll here right now. And the question is this: which of the following would you rate as the most important factor? All of them are important, but what's most important in dealing with the current scenario? Maybe you can have your pick, and Praveen, you can have your pick. Is it the analyst? Is it the policy? Is it the process? Or is it technology? Let's see what the audience also have to say, and the panelists can also poll this time. And Tamas, maybe you should tell us what you voted for before I declare the results, Tamas.
Well,
he will go.
We all know what he's going to vote for, don't we?
Well, it's a tough question, because a robust technology platform is a prerequisite.
Sure.
Yeah.
I mean, look,
I would believe in the combination of trained analysts and the robust platform.
Yeah.
Well, let's see what our audience had to say, and I will conclude on this session, if you don't mind. We are 3 minutes past our session time. And the winner is, there you go, it is robust technology platform, Tamas. I think that seems to be a strange but nice coincidence. Look, on that note, I would take a moment to thank all our panelists and all our audience who've logged in from various parts of the world. Hopefully, we did justice to a session that was sharing some of the experiences and perspectives from practitioners, right? Not just people who actually are participating in the process, but actually living and breathing it day in, day out. So thank you, Mahdi. Thank you, Praveen. And
Thank you.
Tamas, thank you for sponsoring.
Thank you.
Yeah. Have a
Thank you
wonderful
very much.
day.